Hey, good evening, everyone. Marty Missouri here, April 8th, 2022, with your weekly economic update. We'll do the usual. We'll take a look at our index. We'll take a look at a handful of its inputs. And once again, I'll do a quick technical analysis with you of the S&P 500. So 10-point drop this week in our index. That's not small, down to 12.7, but still room between here and what we would deem recessionary conditions. Things to look at this week would be, to start with, auto sales. Auto sales in the U.S. rolling over a bit here. For the longest time we blamed inventories, bottlenecks, can't get new cars and so forth, or can't get cars to the lot. I think there's still some of that, but when you read through the consumer sentiment surveys, you would expect auto sales and sales of other things to begin rolling over. So I think there's some real demand issues that are beginning to show up in the economy right here. Consumer debt, although if consumers are in the doldrums, they still are in the mood to spend money, or at least they were in February. There's a lag here, so this was just updated last week, but it's as of February 28th. The expectation was actually for $18 billion in terms of new debt taken on by consumers, $42 billion in total. There still is a real willingness to get out there and spend some money right here. And the jobs numbers would support that. People should be feeling confident about their ability to earn an income right here. Although, again, referencing those surveys, apparently their income is not keeping pace with the rate of inflation, and perhaps that explains a good chunk of this big ramp up in consumer debt. Mortgage purchase applications rolling over again this last week. 30-year mortgage rate up to just shy of 5%. Refinances, of course, have fallen off a cliff here of late. So again, makes sense relative to what we're seeing in the consumer surveys and what we're seeing in inflation, home prices, and now rising interest rates. The ISM, Institute for Supply Management surveys. We missed the manufacturing one last Friday because I had to do this on Thursday. I told you I didn't think it would drop enough to change its score, which it didn't. Services then came out this week, the services survey, and it actually ramped up a little bit. But when you read through both of them, huge challenges being expressed or reported with regard to inflation, bottlenecks still, labor issues, getting qualified people to work, labor costs, passing through costs to consumers. But I will say, though, that underneath it all, still a notable amount of optimism about their present and go-forward conditions. That's a really good thing to hear relative to the prospects for the economy. Again, to sum this up, I can sum it up here and say you're going to find that the conditions are very mixed, and you're getting a lot of mixed signals, although on balance things are slowing down here. Heavy truck sales, pretty good recession indicator historically, really dropping here. A lot of talk this week. A couple articles were written about the potential for a transportation recession, and a lot of people are saying it's more about demand right here than it is capacity. Yesterday, Thursday, I did show you, the cost of shipping containers from Shanghai coming down and so forth. You sure would expect that to turn back up when you think about the huge lockdown that's going on there. If it doesn't, that could very well be saying something about demand. The sector to S&P 500 ratios, we did this week as well, so we don't need to belabor that. It did go from a neutral to a negative. There still are some economically sensitive sectors that are outperforming the S&P, like consumer discretionary and materials and energy. The latter two, I think we could probably attribute to inflation. But tech, financials, industrials underperforming the S&P. And the icing on that cake is really the notable outperformance by consumer staples, utilities, and healthcare, right? So think about that, folks. When the economy is sour and people are not doing well financially, they got to eat, right? Consumer staples. They have to keep the lights on and the house warm, utilities. And if they break a leg, they're going to get some health care, whether they feel like they can afford it or not. This may be the market anticipating a real slowing in the economy going forward. And then back to the transportation topic. I did load this chart here for you. The white mountain chart here, the white line, that's the Dow Transportation Index. The blue is the Dow Jones Industrial Average itself. There's a theory that's a century old called the Dow theory, and one of its main tenets is that transportation stocks lead the economy and is still very well respected and very written about even today. And so what I did here is I created this chart and added in U.S. recession. So I'm going to type in 1985. So, we can get nearly a 40-year look at this and see if indeed there were any clues leading into recessions. So here we are in 1989, folks, and again, the white line here is the transportation index. The blue is the Dow itself. Absolutely, the Dow was rising right here, right up to the recession, while the transportation index had notably rolled over. Here we are before the early 2000s recession, and here's the Dow rising, and then consolidating a bit or flattening out here right ahead of the recession before dropping like 50%. Quite a ways before that, the transportation index was rolling over and giving you that real bearish signal. Here we are in the 2008 Great Recession, Dow rising right up to the point where the economy rolled over, the transportation index rolling over several months before, and then the COVID recession, right? You could say it was just a complete surprise. Remember, our index began flashing recessionary conditions in August of 2019. So look at the trend in transportation was flat while the Dow continued to rise. That was a bearish divergence right there. And again, here's the look on the 1-year chart today. So absolutely a big red flag to pay attention to there. Okay, so quickly the S&P 500. That's the monthly chart. I'll come back to that. We'll just do the daily, the weekly, and the monthly, and we'll do it quick. So on the daily chart, remember that we had this rectangle that I drew here. It looks a lot like the rectangle we had already drawn back in 2018, tested it 3 times, failed it, and we had a 20% decline. As I like to always say, nothing worse than a failed breakout. So the market looked like it was breaking out strongly above that. We're back in that range right here and closed just below the simple 200-day moving average today. So definitely not a good look here, folks. And our base case is that probabilities point to a lower market during the course of this year. Technicals are telling us pretty much the same thing at this point. You can see that on the weekly chart here as well, although it looks a little more encouraging than the daily chart. We do have this resistance line that we drew right here. And recall my long-term study where when we break through the 50-week moving average and we back test it a few times and then fail, without exception over the last 3 decades or so, we have at least come down to test the 200-week moving average, which is consistent with our view of probabilities for 2022. But right now, that we're not there. Right now, we're still above the 50-week moving average. See, it bounced right off of that like a pogo stick, but closed below this resistance level right here. So we'll see how this plays out. Again, just because we say probabilities point to that, does in no way, shape, or form mean that that's what's going to happen. Things can change. There could be some developments that have to do with conflicts in Europe and that sort of thing that could have this market gain some steam. But as we've talked about a ton, there's other huge headwinds the market's going to have to buck going forward here. And then that monthly chart, I'll save the worst for last. We'll go 25 years. Recall, folks, we've taken a look at this already, but recall that we have this sell signal on the MACD. Every time we've had a sell signal on the monthly moving average convergence divergence for the last 25 years, a legitimate sell signal where the MACD line crosses below the signal line. We had something noticeable in terms of declines. 20% decline in 1998, 50% decline when the tech bubble burst, almost a 60% decline, call it 57 during the Great Recession. See the sell signals, right? Boom, boom, boom. 20% decline here during the European debt crisis, 16% decline right here, 2015, 2016. Q4 2018, 20% decline, 35% decline during COVID. broke here. We did get a low single-digit decline from the peak, so I guess that could be all we get here, particularly if this thing suddenly turns back up, which of course could happen. But again, we broke down through it from a rising wedge. This was encouraging when we broke through that bearish divergence on the MACD, but it never did happen on the relative strength index. So here we sit today, folks, with something that's just not very pretty. But again, markets are dynamic, therefore our analysis has to be. So we have to continue to address those risks within our client portfolios, and at the same time express where we see opportunities, in the commodity space and global equities and that sort of thing as well. I'll leave it there. I don't think I need to revisit anything this weekend with you, so I won't be bothering your email inbox this weekend. Look for the morning note on Monday. Thank you, folks, as always, for watching and listening. Hope you have a great weekend. Bye-bye.